Welcome to today's webinar, compiled and produced by the team at BizNews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the BizNews.com channel on YouTube. Indeed it will be, and welcome to you from me, Alec Hogg, coming to you from the BizNews studio here in Johannesburg. Our guests today, we're going to be talking about the Pearl Valley Hotel by Mantis, the founder of Mantis, Adrian Gardiner, who joins us. Well, I know that I can hear him, but Adrian just needs to switch his camera on. And then Deon Lewis, who is from Futureneers, will also be joining us. Well, there's Adrian, and Deon, I think, will be with us in just a minute. There we go. There's Deon as well. And this is one of the most exciting of the 12J companies that we've been focusing on and featuring on BizNews over the past, it's going on for about 2 months now. Deon, it's under 3 weeks, and then it's all over. Then there's no more 12J.
Unfortunately, no more 12J, Alec. So yeah, we're very active at this stage, and there's a lot of activity in the market. And we want to say thank you for our investors that has already committed and have paid their money in.
And that's really, I guess, if you don't plan now, you don't get cracking now, you might be left trying to rush in at the last minute, and you could be found wanting. What percentage of investors usually do come in at the last minute, Deon? What's the normal split?
Yeah, Alec, unfortunately, human, I suppose, you leave everything until the last minute. Surprisingly, last week, we do most of these investments. But having said that, we want to encourage investors, especially if they want to use some of our gearing and funding options to try and make a decision in the next week, because as I said, the bandwidth is stretched.
Adrian Gardiner is the founder of Mantis and one of South Africa's leading entrepreneurs. I remember when we did the biographical podcast with you, Adrian, I was impressed with everything that you've done. I actually urge people who are thinking of investing in the Pearl Valley Hotel to go and listen to that podcast. It's very easy to find. Go into BizNews, put Adrian Gardiner in, and up it'll pop. Because that'll give you an idea of the stature of the guy behind all of this. But why this 12J, or why this investment, Pearl Valley Hotel, as a 12J opportunity? What was it about this company that made it such an appealing prospect?
Good morning, Alec, and thank you and all your listeners for having us on this, and for what you've done to help us promote not only the brand, but also the 12Js, in which we are obviously hoping to close out, as Deon says, within the next week. And I must say that it's been incredible uptake that we've had already. So I'm not sure exactly how many rooms are left, but hopefully there's enough for your listeners that are going to participate today. And I think, as Deon said, it's quite important. I think that the decision is made quite soon. But, you know, your question really about why Mantis at Pearl Valley. And, you know, it's an interesting story because, you know, Pearl Valley's basically gone through 3 owners. Actually, we're the 4th owner, because it started with, you know, the overseas investor who sold to Dubai World, who then put it into business rescue, and the bank had it. And then what happened is that Mantis, together with a partner, and Valdevi, bought the estate. And I think that, you know, if you see the value of what's happened to properties on that estate over the last couple of years, and the vision of the developers of Valdevi and what we've done at Pearl Valley. You know, we just think that it is one of probably our most valuable assets, even in COVID. You know, we're obviously struggling, but I mean, there has been uptake in terms of usage of rooms and everything. And it's just a very unique product for not only South Africa, but I think for Africa. You know, the Jack Nicklaus golf course, the incredible spa that we've got there, the offerings that you can do. You know, you can go over to Gardiner, and then the usage that you have in that room. And, you know, the offering that we've given to people who invest with us at that, Mantis can have, you can join and you can go and stay at Mantis properties at a discount of at least 20%. And then also, obviously, you can use those usage rights at other developments that we're busy with, which is in BT. And we're in the planning stages, and we're nearly there with developing something similar at the Lynx at St. Francis. So this is something that if you got in now, and I'll just say to you and your listeners, the guys that came in phase one, you know, the price of the room there was 1.3 to 1.5 million. And, you know, you're looking at the room price today now of 2.6 million. And I mean, that's in 3 years, 3.5 years that you've had that capital growth. And I've seen the capital growth of people that have bought stands at Pearl Valley and put houses on there. So in my mind, it's definitely one of the better investments that I think you guys can make. And if you get that tax break through doing it through a 12J, I'm surprised, Deon, that we're not sold out. But maybe by the end of the interview today, we will be done.
It feels like it. It does feel almost too good to be true, and that I'm going to be quizzing you guys about in a little while. But just to let our attendees know, there is a question mark on your control panel. You click the question mark and you then ask questions. And this is your last opportunity to ask questions of Adrian and Deon before you get to invest in something where the tax man effectively gives you 45% of the investment. That's if you're in the top income bracket. We know all about 12J. We've spoken a lot about it and written a lot about it and done interviews on it on BizNews. So you're on the webinar, you understand the benefit of 12J, the tax benefit. The question that you have to ask yourself today is whether Pearl Valley by Mantis is a good investment. Now, Adrian's already told us you're adding a lot of extras, and that's for golfers or even fake golfers like me. It is a great attraction, a great appeal. Although I don't know if you're going to want to have too many 21 handicaps playing around there at Pearl Valley, Adrian. You know, we tend to take bigger divots than the good golfers, but it is a number 2 golf course in South Africa, so there's a lot of that appeal. But please, I would encourage you to do the write in your questions. We're now going to get Deon and Adrian to go through our through the presentation that they've done here. Post your questions. I'll stop them along the way and we will ask them. But which of the two of you are you going to share the slides, guys, or how are you going to be handling this?
Deon, yeah.
Let me start, Alec, and then I will pull Adrian in where I feel necessary. When viewers have questions, we'll field them depending on where it's directed. Yeah, so I think, you know, firstly on our track record, you know, important for investors to know that they're investing into or through a 12J structure that is reputable, a structure that already balances. And some viewers would know that there is some risk in a 12J if the 12J's investments doesn't balance according to the rules of 12J. So we passed that point already. We have close to, in fact, by now, already over 300 million under management, 50 million project pipeline that we're sitting with right now. After the last 2 weeks, over 140 actually Section 12J investors that have invested, 23 underlying QCs, and again there's a rule in 12J that you have to have a certain amount to balance the fund. We passed that point, and in fact over 200 12J certificates issued as of this morning. This presentation was updated 2 days ago. Yeah, and then our track record in partnership with Mantis, very important here. We've been working very close with them. As I said in my previous podcasts and webinars, this is the 3rd season that we assisting Mantis to raise capital for the Pool Valley Hotel. Great partnership, and we're very proud to be associated with Mantis and with Pool Valley Hotel.
Yeah, partnerships are everything, aren't they? If you build up that trust, there's no substitute for it. There's your team.
Yeah, from a management perspective, executive, hands-on, on the left-hand side, Jaco Gerber, in fact, we're all ex-PwC. Jaco is our group CFO. Dirk van Lochenberg at the bottom there, also CA, and then myself. Those are the hands-on team. And then we've got an advisory board, and you'll notice that, we have the likes of Renier Swart, who is the sales director, a shareholder at Valdevie, as well as the CEO of Valdevie Construction, on this advisory board. So we work very closely with Pool Valley and Valdevie, especially on this project. Stefan van Niekerk, transfer attorney, we work very closely with in terms of property transfers. Johannes Boysen, serial entrepreneur that we've been involved with for many, many years. And then Neil Hobbs. Alec, you will probably know Neil very well. He's not only a competitor of ours, but we work closely with him in terms of projects together. So Neil's on our advisory panel, probably the leading mind as far as 12J is concerned in South Africa. He the very first 12J registered in SA, and proud to have Neil on our advisory board.
Well, what's interesting about all of this is it's professionals, and as you say, ex-PwC. So you guys are accountants, or you are members of professional bodies, and that does bring a lot of credibility as far as the investors are concerned. Do you want to take us through this slide? And by the way, we've already got quite a few questions, so I'm going to let's do this slide quickly. You can understand or tell us about the structure, and then I think we can start the first of the questions. And by the way, when you put your questions in, I only refer to you by your first name. So we'll keep it as anonymous as possible. You need to know who, well, obviously you made the question, you asked the question, but I will only say that this question is from Denise or Carlo or Deon, rather than putting your surname, just to keep your anonymity. So don't worry, the whole world isn't going to know about the question that you asked. Deon?
Thank you, Alec. Yeah, so the important message I want to get across in this particular slide is that through the 12J structure, you own an indirect share in a company that owns these hotel rooms. So I want listeners to view it like follow. If you and a friend decide to, buy one of these rooms, and you set up a company, a NewCo, you both capitalize the company 50-50. That company then acquires a room from the developer, and it then rents that room in the rental pool back to the hotel operator. It's exactly the same principle. If I take you through this slide then, so the investor takes up shares in Futureneers Capital in a specific class of share, which class of share is linked exclusively to the economic rights of Hotelco in this case. So this company, the exclusive business of this company is to acquire rooms from the developer, Pool Valley Hotel rooms only. It then has a contract with Mantis as the hotel operator, and then the proceeds, in this case, the 6% per annum gross yield as an example, which we'll get to a little bit later, is paid into Hotelco. There's obviously company tax, and then there's expenses in there proportionate to the investor's investment, for example, rates and taxes. It's marginal. Dividend is pumped up back to Futureneers Capital. No dividend tax there because it's company to company, and then a dividend pumped up to the investor, and there's dividend withholding tax. So the investor gets his rebate back from SARS, and in this process, he owns an indirect share in a company that owns hotel rooms.
Right, so that gives us the insight. I'm going to go to the first of the questions from Denise, and it's for Adrian. Adrian, you spoke about property values and capital growth. Can you tell us briefly how these have grown in the past 5 years?
Yeah, well, obviously Pearl Valley Hotel hasn't been going for that long. So it's, I think the first rooms were sold almost 4 years ago. So as I say, the growth has been, but some of them were only sold 3 years ago. So the growth has been over the last 4 or 3 years.
Okay, so the numbers that you gave us earlier are, well, do you want to just repeat them for Denise's
so in
benefit?
other words, we actually sold the first lot of rooms 4 years ago at 1.250, and then the last ones in that phase were sold for 1.5. And so those rooms currently, on today's selling price, have gone up in excess of R1 million over either 3 or 4 years. So the capital growth has been quite phenomenal. And we just say that, and it's quite interesting in that even our development costs didn't go up that much because obviously the builders in the situations that they are. But I think that it's the value has gone up because of the place where the rooms are, where that hotel is. As we said earlier, and as you elaborated on it, is that there's a lot more than just golf there. You know, it's in the winelands, it's close to Stellenbosch, it's close to Franschhoek, it's easy accessible to the airport, to Johannesburg. So, you know, there's a lot of things in its favor. I mean, Valdevie Estate, which obviously includes Pearl Valley, has been voted as really one of the top estates in Southern Africa. So there's a lot going for it at the moment, and people are wanting to have that security and all the infrastructure of an estate. So I think that that's what's really achieved the capital growth that we've had, which I think is quite unbelievable.
A question from Carla, and I think this is for you, Deon. She says, can I transfer my Provident fund directly into a 12J investment?
No, Alec, you can't do that, unfortunately, no.
Okay, I thought so, but I guess, well, it was worth asking. Another Deon, your namesake, says, I originally applied to the Pearl Valley 12J, but ended up with the Solar KSE. Both of them are managed by you guys at Futureneers. Why and what is the difference? That's an interesting question.
Well, I really can't answer why the investor made that decision, but one has to obviously look at these two assets as completely different. You know, the one is a solar depreciating asset investment with a guaranteed return at the end, whereas this is a property investment with a massive capital appreciation upside. So it all depends on what the investor's appetite was and what their risk profile is. You know, property is arguably the lowest risk investment that you can make, whereas that is a little bit higher. So I can't answer why the investor made that decision.
All right, so he's going to have to just get hold of you and then discuss that, no doubt. Carla has a follow-up question, actually, to Denise's question. She says, if you have a indirect share, I assume the appreciation via dividend income would only have capital gains tax implications if you sold the room. Is that accurate, Deon?
100% accurate. When we get into the internal rate of return calculations later in the presentation, you'll see it clearly. So the capital growth element of the contribution to the internal rate of return calculation is obviously only realized when the investor decides to exit the investment or liquidate his investment. So absolutely yes, if while you're in the investment and you decide not to exit, the capital growth is obviously not, doesn't befall you. It only does so when you exit, and then obviously proportionate to the investment that you put in rand value.
Okay, so it's like the investment in any company, really. If you even a share on the stock market, you only are liable for capital gains tax when you physically do that sale. Let's carry on with the presentation, Deon.
Okay, Alec, if you can just take me to the next slide, please.
Okay, it should be up there. It's personal use benefits at the top. Can you see it?
There we go. Now I can see it. I'm going to ask Adrian to maybe come in here on one or two of the points, but just in terms of the room nights, so for every R1 million that you invest into this particular 12J product, you get 10 room nights in the Pearl Valley Hotel to use per year. You can't carry them over to the next year. If you don't use them, you lose them. So what we mean by free usage, there is only a cleaning fee that's applicable if you stay there, and you have to pay for your breakfast. But the rack rate of the room is not charged. If you start using some of our gearing options, which we'll talk about a little bit later, the bridge loan and the smart loan, you'll notice that it reduces slightly to 8 and 6 days respectively per year. And important here that there's no restrictions in terms of booking during peak times for investors. So if you get in early enough and you make your booking early enough, there's absolutely no reason that you cannot use the hotel during peak periods. And then important, you can also gift or sell these room nights if you don't use them. As long as you, as the investor, make the booking for the person that you're selling it to or that you're gifting it to, there's no reason that you can't do that.
Let me just understand this, Deon. With timeshare, for instance, when you want to go during school holidays, there's always a premium, particularly if you want to go through the December holidays. In this case, you just got to plan ahead, book ahead, and you won't have to pay that premium.
Correct, 100% correct. Then there's a 50% discount applicable. So let's say, for example, you've invested $1 million, you used up your 10 room nights for the year, and you want to go and stay in the hotel after that, you'll qualify for a 50% discount. And also important here that there are double rooms, in other words, 2-bedroom units available at Pearl Valley. So if it's a family with 4 people and you use a double room, and you go for 1 night, it will mean that you use 2 of your room nights. So it is configurable as far as that's concerned. And then, as Adrian alluded to earlier, additionally, you will qualify for 20% discount off the rack rates of any of the other Mantis Sub-Saharan African assets. So you're flexible as far as that's concerned.
Sub-Saharan, Adrian, you need to come in here because it's not just in South Africa. What else do you have in other parts of the continent?
Well, we have rooms in Nigeria, and we're obviously in the Middle East, which is not Africa, and then obviously London and that sort of thing. But again, you know, I'm not just saying it's Sub-Saharan. If you came through to us as an owner and said, look, I'm going to London and we see you have a hotel there, could we qualify for the discount? The answer is yes, but we just didn't want to put it there and complicate the thing. But you know, when you look at the assets that we have in Sub-Saharan Africa, and probably the most popular of all of ours are the boats on the Chobe Zambezi. So we got the 4 boats there and the lodge there. And I mean, those things, if anybody has not done that and seen wildlife from the water, I can tell you now that that's a bucket list thing that you should be doing. So, you know, there's quite a lot of varied product that we do have. So, you know, Sub-Saharan Africa, it's worth talking to us about it, and I'm sure that we can help in most cases, even if you went out of Sub-Saharan Africa, that we'd be able to give you the discount. Because I think you made a very important point in the introduction when you mentioned the word partnership. You know, and Deon and I, as we say, are partners in this development of setting the 12 J's, and we've had a good relationship with you. But we consider the investor in a room of ours at that hotel as a partner. So in other words, you're just not an investor and you're just not a cold guest or whatever the case may be. So, I mean, our team on the ground there are very aware of who all the investors are, that they do get looked after, not any differently to any of our other guests, but we review you as a special person because you have invested in an asset of ours.
So just to clarify, if I invest in Pearl Valley, in the Pearl Valley Hotel, and I want to go on one of the boat hotels on the Chobe River, for instance, I would get a 20% discount.
Correct, but you must book it direct with us. Don't go through operator where we have to give another 20% to, whoever the case may be. So it's a booking that has to be made direct with us, and the best way to do that is do it through the reservations office or discuss it with the reservations office at Pearl Valley, because they know how to handle it.
There we go. All right. So it'll all be handled through Pearl Valley. You want to go on various other, or you're part of the family and you'd like to use that relationship. Got it. Okay.
You're an ambassador of ours. That's how we like to look at it.
So as an investor, you become an ambassador of Mantis. You benefit for these over the, additional benefits that do become part of being an investor here. Deon, do you want to carry on?
Yes, thanks, Alec. As far as golf rights are concerned, now golfers would know that this is a unique mechanism that we've got here. So it's a proportionate membership fee. So let's say, for example, membership at Pool Valley, I don't even know what it costs. I think it's probably 20,000 Rand a year. I don't know more, but let's assume it's 20,000 Rand a year. And you go and stay in the hotel for 3 days. It'll be 20,000 Rand divided by 365 days times 3 days. So that'll be your membership fee that you pay. And then you'll qualify for membership green fees when you're in residence. So that's how that works. And then the swap out features that Adrian alluded to earlier, currently you can swap out on a one-by-one basis with Zambiti. That's going to be completed, I think, towards the middle of Adrian, when end of this year?
No, we're hoping to give occupancy by end of July, beginning of August. So that's imminent now. It's just that, fortunately for them, they've had rain after rain, and it's meant to be winter there, and we've had no rain in Port Elizabeth. So building has been delayed a bit there, but not the interiors, just the access.
Okay.
But Zambiti is a part of this, and then the St. Francis, the Lynx, which is a magnificent property. How far off are you from building the hotel there or having rooms available, Adrian?
It's quite close. The spatial development program has been passed by the local municipality. It's a case now of just submitting plans to get the plans passed. And then there's an issue on the site which we're attending to. It was a dump site with some plastics and stuff that we're just removing. So we hope to be building there, I would say within the next 2 to 3 months, we hope to turn soil. So I had a meeting with the professional team yesterday, and we're hoping for occupancy there by the end of next year. So it's quite imminent. And there, again, there are hotel rooms, there are houses there, villas we call them. I'm not sure how many villas will be in the rental pool. There are 2-bedroom units there, and there's single units and double units. So I think it's quite an amazing development. And as you rightly say, it's on a Jack Nicklaus course again at a magnificent part of South Africa.
So let me get this right. After the end of next year, when you're in the Lynx, if I invest R1 million before the end of June, because then the 12J is ended, I will get 10 room nights. And those 10 room nights, I could go off, say, to play golf at Pearl Valley for 3 days, Zambiti for 3 days, and 4 days at the Lynx. That'll be part of the whole of the package.
Correct. But I mean, obviously, all it's subject to availability and that sort of thing. So as you rightly said in the early time, because there's no restrictions on when you can go and when you can play, you've got to book in advance.
Sure. Carla's got another follow-up question, and I think it's relevant for what we're talking about now. She says, if she invests R1.5 million, does that translate into 15 days a year?
Correct. 100% correct, Alec.
Okay, so it's 10 days, 10 room nights for $1 million. Put in R1.5 million, you get 15. Okay, very nice. Right, and there's another question here from Armand, who says, if you want to get out of the investment, do you have to wait for a new investor?
Yeah, that's a very, very good question. And I suppose that is the jackpot question as far as how do you exit this investment should you at any point decide to do so. Firstly, you can exit the investment at any point in time. The VCC has to buy your share back from you. Obviously, we don't advise investors to do that in the first 5 years because there will be a recoupment from SARS on the benefit that you received. But let's talk about after 5 years, because I think that's where the question is directed. One has to look at this investment as a property investment. That's what it is. If you invest into any property, your exit is willing buying, willing seller. So what we have to do as a fund manager to exit the investors after 5 years. So we'll be asking in end of year 4, who wants to exit? We then take some of the rooms that PropCo entity that I've explained in the first slide owns, and we put them onto the open market for sale. That's how we create liquidity in the fund to then buy the investors' share back. Obviously, there will hopefully be capital growth at that point in time, and the investor will receive his proportionate capital growth through that process. So to answer the question, there has to be a market for these units, and if you look at it from a fundamental perspective, I think we've spoken about the asset. We know where it is. We know what the demand is for assets there. And then the second key value driver would obviously be how the hotel performs. You know, if this investment gives the yields that we believe it can, then it will be a desirable asset for investors to reinvest into.
Okay, so it's a bit like a share buyback that, if I understand you correctly, after 5 years. But the critical thing here is that this is a 5-year investment. You're not going to get your 45% deduction from SARS if you're a top income earner, and then SARS just lets you cash it in a year or so. You've got to be there for the full period of 5 years. That's how the law works. But thereafter, when you say that you'll be putting funds into a reserve, is that like with a company on the stock market that buys back its own shares? You'd be buying back for the benefit of the company as a whole, from those investors who want to sell.
Yeah, we're getting a little bit technical now, Alec, but effectively, yes. So the VCC will buy the investor share back, and for it to have funds to do that, it has to liquidate the assets. In this case, some of the rooms.
All right, but the point is, you are aware that there are going to be some of the investors in the company who are going to want to sell their shares after 5 years, and you are making allowance for that. On to the next slide.
Alec, maybe if I can maybe just add one thing to that point. As far as the sale of those assets at that point in time is concerned, viewers must remember that from a fund management perspective, we are incentivized. Our top incentive lies within the exit process. You know, we take a 20% over a certain hurdle rate. So if the asset gives you more than 5% capital growth, we as fund managers share 20% in whatever the capital growth was over the 5% mark. So it's in our benefit that we need to liquidate those assets at the right price, top dollar, for our investors and for us to ultimately to benefit from it as well.
Yeah, that's very rational. Here's the next slide for you, Deon.
Thanks, Alec. Yeah, so what we're trying to show here is, and this is based on a cash investment of R1 million, with the assumption that the investor is on a 45% tax rate. So what I'm trying to show you is the building blocks of how we get to the 20.8% internal rate of return, which calculates back to a 16.7 after tax return. So let's start at the bottom. You'll notice that there's a minus 1.8% that it starts off with. So that represents the corporate tax in the PropCo entity. If we go back to that first slide that we spoke about, there's property taxes as a cost in that entity, and obviously audit fees of that particular company. The 3% above that is then the value of the room nights that we've spoken about earlier. At a rate of 3,000 Rand per night, if you invest R1 million, those are 10 nights, so that calculates back to 3% of your return. And one could argue that you want to necessarily take that out of the return calculation. It's not really part of it, but I mean, you're still sitting at 17%. The 6% above that is then the yield, the gross yield that Mantis, as the hotel operator, would be paying the PropCo entity. And then the 5% above that is the capital growth estimation that we've worked on. Now, as Adrian alluded to earlier, the real growth has been 19% a year over the past 4 years. So we think that 5% is more than realistic in terms of this particular calculation. And then the black little block there, the 8.1%. So that's the effect of 12J. That's the kicker that 12J brings to this investment. So that's your 45% annualized over a 5-year period. And that brings you to the 20.8.
How hard is that 6% from the hotel operator? In other words, it's got to be based on things like room occupancy rates, the scalability of the hotel, the revenue you're expecting through there. Please God, there's not another COVID or it doesn't continue indefinitely. But what kind of numbers there for a conservative investor are are you working from?
So I want to go back 2 years to answer this question. So let's talk about pre-COVID. At that point in time, the hotel was running at a 40 to 50% occupancy level. And immediately I'm hearing viewers saying that that's relatively low. There was a very good reason for it. If you look at phase one of the hotel and the configuration of phase one, I think there's 37 rooms, Adrian, of which at least 10 of them are double rooms. Now, the problem with those double rooms are they're not configurable as a single room. So what the hotel experienced was larger groups of, corporate bookings, for example, that wanted to come and do, strat sessions or whatever at the hotel. They couldn't accommodate those groups because people didn't want to share rooms. So that was the rationale behind developing phase two of this hotel, which added another 40 rooms, single rooms, which are the ones that we now selling. So pre-COVID projections with phase two online, we were looking at 60 to 70% occupancy rate. Obviously with COVID now, major problem. I don't know what the occupancies are currently, Adrian, maybe you can tell us a little bit more. But we think that, a 6% is more than achievable based on, where the trajectory that the hotel is on.
I think you've actually summarized that very well, Deon, is that you're quite right in saying that although they are two separate rooms within a flat, that you were sharing a sort of, call it a flat that was two rooms, and as you say, people wanted their own independence. So, but we soon figured that out. And we could have redesigned when we did this, but we figured that it was far better to do the single room. So it was 40 rooms that were built, but of which of those, I think there were 8, so 16 rooms, as you rightly say. So we could only sell 8 rooms there. And pre-COVID, as you said, and for a new hotel to be open and doing its second year, 55% occupancy, even with those configuration of those rooms, is in the industry not bad at all. Second, and I'll tell you what it's all about is what rate do you achieve. So that's the important thing. Forget about occupancy, you've got to get the right rate to get the return. And obviously we were then just trying to position the hotel, and we soon realized that, if you have a golf day, 40 rooms, or as it was less than that, 34 rooms or whatever the case may be, it doesn't help you because you can't accommodate enough people. And we have a conference center there that can take up to 100 people. So hence the phase two. Now during COVID, and I mean, it's pointless in me trying to tell you that, because we were closed for a certain number of months anyway, like the whole industry had to close. And when we reopened, I think the best occupancy that we've done since reopening was only 35%. And now again with COVID in the phase that it is, so to look at occupancies during COVID, and that's why we've given you a guaranteed return for the first 2 years of any investor that comes in. And we're hoping by then that the market would have changed. And I think that the hotel has certainly been on the market then for at least 4 to 5 years, although with very limited occupancy for 18 months to 2 years of that because of COVID. But I think that your 6% projection is fair. But again, it's dependent upon obviously borders opening, because a lot of our business is international. And I think that that's one of the risks you take in any investment that you go into. But I think that you've got a piece of real estate that's certainly going to climb in value. I have no doubt about that. And I think our brand adds value to that. So I'm very happy with your projection.
And I also think, just adding on to that, Alec, just a comment. This is important because, and these are real numbers, in the year before COVID, before phase two of the hotel was online, the hotel had to basically send away 1,600 bed nights of groups that wanted to book, but the hotel wasn't big enough. So there's a nice stat for for our investors to take cognizance of. And then the 6%, just back to that quickly, important. The first 2 years of this investment, we've negotiated with Mantis for a guarantee on that 6%. So for year one, you've got 6% guaranteed, and year two, you've got 6% guaranteed, and that's in the form of a bank guarantee. So touch wood, Mantis something doesn't happen to them, but if it does, that the investor's money is at least safe.
Okay, so I get it now. The 6% is guaranteed for 2 years, one would presume that we'd be back to normality after 2 years. You've got the single quarters, if you like. I mean, it's hardly single quarters, but you know what I'm getting at, single rooms, which is going to mean you don't have to give away the 1,600 bed nights that you did in the past. The big question here is that 3% on free usage rights. So if you don't use those 10 nights, then your actual return will come down from 20% to 17%. So is there any way that if you don't use the rights, that you can get anything back for them? Can they get put into a pool or something along those lines, or are they use it or lose it?
They are use it or lose it. You could sell them privately to someone else, but unfortunately you can't put them back into the rental pool and expect payment for that. The model doesn't provide for that.
Okay, so base case here, if you don't use your 17.8%, if you use your rights, the effective return is 20.8. Got it. Are we moving on to the next? Oh, sorry. Here's a question again from Denise. She says, what is the minimum investment?
Yeah, so R1 million is the minimum. If an investor wants to invest less than that, please talk to us. There's a process that we have to follow, and it's got to do with the fact that this is not a public company. But have a chat to us. We will engage you on potential 500,000 Rand investment.
And what about gearing up? If someone, say, has only got 100,000 Rand, are they completely out of here, or could they borrow or be facilitated into borrowing to get to a higher number?
Absolutely, Alec. And I think we will get into a little bit more detail in the following slides. But yes, there's a gearing option that we make available to investors. Can we maybe just field that question a little bit later when we get into that slide?
Indeed. On to the next slide.
Okay, so this is now the detail of how we get to those calculations. So this is a return calculation. This is how we get to the IRRs, and it also shows you the cash flow for an investor that invests R1 million. So there you'll see your million goes in year 0. In year 1, you'll get your 450 back from SARS. You'll start getting your dividends, and there's the value. The 30,000 is the value of your room nights. And if you follow that through to year 5, assuming that you liquidate the investment, this is what your cash flow looks like, and that equates back to the IRR that we've explained. So important here, and we'll get into the fees on the next slide, but the difference between this investment and most others is that the 12J fees are actually included into your subscription price of R1 million. And there's a very good reason that we do that, and I'll explain it in the next slide. But effectively, the money that flows down into the actual investment is the million less the 12J fees over a 5-year period. So we take the fees off, and the balance goes into the investment. Maybe you should go to the next slide. I just want to quickly explain this. Thank you. There we go. So you'll notice that the upfront fee is 5%, and then there's an annual fee of 1.5%. So this totals a 12.5% fee over the 5-year period for this investment. But because it's included in the subscription price, you actually get a tax benefit on this. So your net effective fee on this investment is 1.3% a year.
Okay, that is, well, do you want to go back to the previous slide? Are you happy that we through with this one?
If there's any questions, I'll field them here.
Okay, well, let me just get to, because there are a few more questions. One, Armand has got a follow-up from his previous question about exiting after 5 years. He says, listening to your answer, could there be a delay in exiting your investment? In other words, do you need a buyer willing to pay the price? So if my assumption is right, it means the selling price will depend on what the buyer is prepared to pay.
Yes, again, it's a property investment, and the property will have an intrinsic value at that point in time, and we have to sell them into the open market. But what needs to be understood is that we will have at least a year to start selling these properties in year 4, or year 5 rather, to enable an investor to exit at the end of year 5. So there's time for us to liquidate the assets. but there could be a delay. So if the market tanks, or touch wood, anything happens to to Val de Vie and Pearl Valley in terms of whatever, I mean there could be, but we believe that the exit mechanism is elegant.
Okay, so just understand it's a company that owns a hotel, and like any other company, you're making an investment in it. It is exposed to all kinds of risks that could happen. But there's another question here from Fred. He says, I assume the post-tax IRR is a nominal IRR, that the IRR does not take into account the capital gains tax effect when selling the asset in 5 years. The 6% gross yield also does not include any expenses to bring this to a net yield. Are these expenses included in the 1.8% pool of taxes and audit expenses? Okay, a little complicated, but Deon, I'm sure you can unpack that.
Sure. Let's take the first part of the question in terms of the capital gains tax element on the exit. The post-tax IRR of 16.6% or 16.7% takes into consideration and assumes an exit in year 5. So you'll notice in year 5, there's a deemed exit and there's a capital gains element of 201,000 Rand, which is again from a base cost of 0 on the 1.1 million. So it assumes that. So this is a post capital gains tax IRR. As far as the 6% yield is concerned, 100% correct. So the 6% guaranteed yield is payable from the hotel operator into the PropCo entity that you are indirectly invested into. As I said, there's company tax in there, and there's rates and taxes in there. But this calculation, this dividend yield that you see in here of 36,500 is after expenses.
Okay, good stuff. Right, are you happy to carry on to the next slide?
Carry on.
This one we have covered. Here we go, risk versus return.
So what I'm trying to demonstrate here is to show that on a risk versus return scale, looking at a call rate investment in the bank of 3.75, almost zero risk, compared to a traditional venture capital investment giving you 30 to 40% returns. This is a low risk investment in property with a return closer to the high end scale of a high risk type investment.
Okay, Adrian, we haven't heard from you for a while. You want to chip in?
Well, I'm just interested in seeing that and following it through. And obviously, I've been through this with Deon and all the rest of it. Is that I think that when you look at what you're doing here, you're investing, as Deon rightly says, in a property, and the property that you're investing in this circumstance gives you a lot of other benefits besides just the property at Pearl Valley. But you get the benefits of, certainly if you want to travel around, you can explore the Mantis properties, and there's many other things. We're associated with Accor. You get the Accor loyalty program card. There's a lot of other things that come with it. So I think to look at it as a cold property investment is obviously that's the first thing you got to do. Is my asset fully protected? Which it is, because it's a property that it's a sectional title, so it is protected. So I think that it's a bit more than just a property investment. I think it's a lifestyle investment that you can, with your family or friends, use certain of the other properties that we have. So I just think that it's an amazing opportunity, and I just hope that your listeners are going to take advantage of the few rooms that we have left.
Right, Deon, next slide.
Okay, so getting into the funding options, maybe answering some of the questions that came in earlier around funding options. So there's 4 potential options to make this investment. Obviously, the first one is cash. We've spoken about that. We have a bridge loan available where the investor has to put down 55% of the cash up front. We then bridge you 45% of the investment over a period of 3 to 14 months. And the reason it's 3 to 14 is depending whether the investor is a provisional or a PAY taxpayer. The interest rate there is prime +2, and the reason for that is we don't ask the investor to sign any personal sureties. The smart loan, I think specifically answering the question of earlier, 5% cash upfront. We then lend the investor 95% of the investment value. But importantly here, and a very innovative model in the sense that your monthly premium is calculated over a 20-year period. So had you bonded 950,000 Rand, you would have paid in the region of 9,000 to 9,500 Rand per month. Yet with this investment, you're settling this entire loan in under 5 years. And the way that we do that is the loan agreement with the investor calls for a balloon payment at the time when the investor receives his rebate back from SARS. So your rebate from SARS funds your balloon payment, which at that point in time puts you at about a 50% loan to value ratio. And then we also take the proceeds of the underlying investment and we offset that against the loan for you. So once that loan is then settled after 5 years, then you've got a fully paid asset, which SARS has effectively paid half for you, with an interest rate or a total interest component, if you compare it over, to a bond that you would typically use to buy a property, far, far less, and we'll get into the detail. And then we get to the Global Hedge 1 solution, where you can either use cash that you've got offshore already, or you can take money out for your discretionary allowance, invest that with Sanlam in one of their portfolios, and then gear against that to then fund your local 12J investment. Now, I'll show the detail in 2 or 3 slides later.
Okay, I see we're getting close to our witching hour. So if you want to put a question in, we only have 7 minutes left of the webinar. Please get cracking, put them in this. Otherwise, we won't be able to ask, certainly not at this stage, of the question of Deon and Adrian. Deon, over to you.
Yeah, I think the bridge loan is very simple. I'm not going to spend too much time since we've got limited time left, but yeah, simple, 55% cash up front, 45% balance loan. That's very simple. Your total cost of funding, assuming that you do a 14-month bridge until next August when you PAYE pay and you get your tax back from SARS, we're looking at a 35,000 Rand cost, in terms of interest. Maybe on the next one, this is the one that I explained earlier in terms of this installment loan, and this puts it into perspective. So the top line represents a 20-year bond, and the green line represents the smart loan. So you'll notice that at the time, in a typical bond where you still owe 928,000 Rand, with this smart loan, you've effectively settled half your loan. And then after 5 years, completely settled it. From interest perspective, over a 20-year bond, you would have paid 1.1 million Rand interest. With this loan, a total of 168,000 Rand.
Okay. The global hedge, this looks complicated.
It looks complicated, but it's not really. So let's follow the top path where you see the Investec logo. So this assumes that the investor wants to make a R1 million 12J investment in the hotel. So we're saying we're going to give you 2 investments for that. So you need 1,050,000 to execute this. So you either have R1 million offshore already, or you take R1 million out through your discretionary allowance. That's the top line. That converts into $69,000 now. We introduce you to a portfolio manager at Sanlam Private Wealth. You sit with them, you decide where you want to invest that money. There's limited products available because wherever it's going to go into needs to act as collateral for a loan that Sanlam will give you at a 50% loan to value. So you'll see that's that arrow that comes down on the right-hand side where it says Sanlam loan prime plus 1%. So they give you a facility, a Rand facility against that offshore investment at prime plus 1. This is not an installment loan. There's no repayment obligation. The interest is capitalized against the facility. So you can either, pay in money there where you have, as long as your overseas investment, grows and you've got the Rand hedge and the Rand depreciates, you theoretically never have to settle that. Obviously, that's not what you want to do, but that's how it works. So it works like an overdraft. So that then gives you the 500,000 Rand, which Sanlam has then borrowed you. We then extend a bridge loan of 450,000 Rand at prime +2 again. You've put in 50,000 Rand cash, which is the one from the left, and now you're making a R1 million 12J investment. So after this process, you're sitting with R1 million offshore investment in a dollar-based instrument, giving you dollar-based returns of anything from 5 to 10%, depending on where you put it. You've got the Rand hedge, you've got a local 12J investment, your SARS benefit that comes back, then settles the bridge loan with us, the 450, and the only debt that you have left is this facility that you have with Sanlam that you can pay at your leisure.
Let me just understand this. That R1 million to start with, that where you've got underneath Investec, do you have to raise that R1 million, or is that part of this whole loan scheme? How much do you have to put up front? How much cash do you have to put up?
Alec, you have to raise the million. So this was born out of investors saying, I'm sitting with R1 million. I'm considering a 12J investment. I want to get the tax break, but I'd rather take my cash offshore. I think I need to run my cash offshore. So we're solving both those problems. So we're saying, take your cash offshore, put it into a portfolio that'll give you dollar-based returns. But we will give you a facility that will enable you to also do a 12J investment. So to answer your question, to execute this, you need R1 million 50 Rand.
Okay, yeah, I understand that now. And that is beautifully timed. The end of the presentation, just enough time for the two of you to give us your closing remarks. Adrian?
Yeah, I think again, from our side is obviously to thank you and your company for helping us to get this out to your audience. I hope that we've answered the questions that have come through, and that there are going to be some subscribers to it. And again, I just want to re-emphasize, Alec, is that all of the investors that come in, please regard us as your partner, and that we will obviously look after you. We do the best we can. We have a track record. We have an international partner. We are connected, and we stand for, I think, some of the good things in life. We have a community conservation fund, and we want to make a difference, and not only for that, but to make a difference to your life. So please join us in this investment.
Deon, your closing comments?
Maybe just one comment. Investors that know that there's a potential to also do the investment into the Zambezi Hotel through the 12J structure, you can split your investment in two. So, for example, 500 into Zambezi and 500 into Pearl Valley. So that could be done. Yeah, and I just want to say, Alec, thanks for you guys. Adrian, thank you very much. We've only got one block left, I think, of the rooms. I think it's 8. So hopefully we will sell that out in the next week or two.
Thank you very much to our guests on today's webinar, Deon Lewis and Adrian Gardiner, giving our community here at BizNews a better understanding of this very exciting 12J investment opportunity, one that the golfers are going to be lining up to take, that's for sure. But outside of the golfing community, the way you've unpacked it for us, it shows that there is there's a lot of appeal right across the board. Well, that's been the webinar for today, our noontime webinar. We look forward to being back in your company again for the next webinar in the near future. In fact, we've got a really strong focus on 12J in the next couple of weeks as we get closer to that June the 30th deadline. Don't forget, that's it. At the end of June, there is no more opportunity to invest in 12J. But I think you already know that. We'll be sending you a PDF later this afternoon, so it'll give you even more information and detail of what is available. Until the next time, from me, Alec Hogg, here at the BizNews headquarters in Johannesburg. Cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.